Well, greetings. As this year begins to come to its quick conclusion, I've been looking ahead to key topics that'll be really helpful, especially for business owners who are deciding that next year is going to be the year that they're going to exit. And one of the most important topics that I feel should be addressed just because of how important it is the topic of clean books. Now, as a fractional COO, when it comes to cleaning up the books, I will admit this is not necessarily one of the areas that I will do a lot of work in, and it really depends on just what the state of it is. I have actually done controller work a good bit, so I'm very familiar with what things need to look like. But at the same time, I also realize that, just because of what I'm doing, is the type of thing that, I realize that, I may not actually be well positioned to do it just because of the fact that it might be better to outsource this. But having said that, as a business owner, you can really well position yourself and help out a lot with the exit planning by process by making sure you have clean books. And what we're going to do today, I'm going to go ahead and jump in. We're going to take a look at clean books and really what it takes to get there. And we're going to be taking a look at some of the common challenges and why having books that are not clean can cause some problems. So, for starters, let's take a look at this $3.5 million mistake. Now, while this is designed to be more on the fictional side, and I don't actually have a specific company in mind, this is illustrative of what can happen. Now, this business was valued at 17.5 million, but it dropped 14 million, a 20% reduction, and it was because the books looked fine to the owner, but the reality is they didn't meet the buyer's standards. Now, obviously we'll get into a little bit more detail what happened here, but the key is the difference between exit ready books and good enough books, that could cost you millions. And part of the reason why is a buyer is going to look at it and go, okay, well, since it's not quite where it needs to be, that means we're probably going to need to do some cleanup work. So basically, you're going to need to take a significant discount. So, what we're going to cover today is we're going to look at 12 specific issues that could kill deals or slash valuations. And it's my hope that you're being aware of them will cause you to be on the look and make sure that your business is not engaging in any one, several, or all of them. We're going to put out a self assessment framework to evaluate your current readiness, a realistic timeline and investment that'll be required, and action items that you can implement this quarter. And I know that, this is the final month of the year, but the reality is if you can get on the ball and start implementing things now ahead of next year, you will well position yourself even more. So let's take a look at why most deals fail. Well, 70-90% of M&A transactions fail to achieve the stated objectives. I'm sorry about that. That slide got a little messed up. But what's saying there's 3.2 uh, average LOAs that are required to close one deal. I'm not sure what happened there with the formatting. And 47% of transactions don't meet expectations. So those are some, that's kind of like a deep dive as far as, what's going on. Now, what buyers actually do during due diligence, and this is something that a lot of the work that I do is aimed at really helping us prepare for, and that is making sure that all these things line up. For starters, there's going to be a quality of earnings analysis. It's going to be a really deep dive to see just how good are the earnings, because I'm sure we've all seen businesses on paper they look good, but when we start digging and we see cash flow and bank statements, what we begin to discover is, a lot of this vanishes really quickly just because of the fact that, that wealth isn't there. Now, going to be 3+ years of financials, examination, reconciliation of every material number, and real related party transaction scrutiny. In other words, this is going to be what you would think of when it comes to almost a home inspection. It's going to be a very detailed valuation just to make sure that there's nothing that's uncovered that could be a problem. So that's giving you an idea about what's going on. And I can tell you, I actually have a platform that is designed to help us with due diligence and make sure that we get all the materials together. And again, the big thing that we're working towards here is making sure that we get everything that we need. Now, here's what the valuation that you need to understand. And we're going to actually go back to that example at the beginning. Um, what was going on here is that the multiple that we were using was 7 and the EBITDA was 2.5 million. And that's where we got the 17.5 million. Now, what happened with the quality of earnings study in that example was instead of having 2.5 million EBITDA, it came in at 2 million. And that, uh, even with the same multiple, that cut off $3.5 million. And really, you can see right here, every $100,000 of challenged EBITDA, would basically the quality of earnings is going to say, hey, actually the EBITDA shouldn't be this high. That's costing you 500,000 to possibly a million in enterprise value. So in other words, what we need to make sure is when we're working to get our EBITDA evaluated, we need to be absolutely positive that everything lines up correctly. Now, here are some red flags that are going to make buyers walk away, and these are not all of them. Again, this is focusing on the financial part. There are other red flags that are not financial that we could go into discussion on, but here they are. First of all, financials that don't reconcile to bank statements or tax returns. Recently, I had a call where somebody asked about, okay, there was this company that was doing accrual based accounting, but when it came to doing their tax returns, they were doing cash basis. Well, my recommendation was they choose one or the other and they don't do that split, because what's going to happen is even though they may actually be accurate, it's going to have the potential to create two sets of numbers. It's going to cause confusion, and the buyer might walk away. Customer concentration exceeding 20% in a single customer. If you're getting 20% of your revenue or more from one source, people are going to ask this question. Well, what happens if that customer decides to go somewhere else? Or better yet, what happens if that customer decides to give a significant reduction in terms of the amount of what you're buying? I mean, all of a sudden, there goes a substantial chunk of your income. Declining trends during the sale process. In other words, your revenue, instead of going up, it's actually coming down. That's going to be a red flag. Related party transactions at non-market rates, they're going to be looking, why are you doing that? And then aggressive add backs without supporting documentation. They're going to say, okay, I'm glad that it's like, okay, it's nice that you did that and you think it's that worth, but can you support why you had such a large add back? And they'll be thinking, okay, well, this does not look like it is actually going to work or make sense. So here are the dirty dozen, really the 12 transaction risk areas: revenue recognition, personal versus business expenses, add back reality, working capital, inventory and fixed assets, tax compliance, GAAP compliance, financial statement quality, related party transactions, debt and covenant compliance, customer concentration, and contingent liabilities. Those are 12 areas that, when it comes to getting the books cleaned up, that you need to make sure that they're in order. So let's take a look at the first one, revenue recognition. This is where the cash basis versus accrual confusion comes in. I remember working with one company where the financials looked great, but then you looked at the bank account and it looked awful. It looked anemic. And the reason why is just because of the fact that with the accrual basis, there were all these invoices. Many of them were outstanding, and they had actually extended aging on them. And so even though, yeah, it was showing income was great, the reality was there was no cash there. And that also illustrates improper timing of contract revenue, where you may actually be putting out an invoice that you really probably should have broken up, just to show that, okay, yeah, even though you're going to eventually earn this and this, the reality is you're only earning a certain amount today or over the course of the next week. Deferred revenue misstatements, it's like, yeah, that's something that we definitely would not want to do. And then the inability to quantify recurring versus non-recurring. It's really not rocket science just because of the fact with recurring revenue, it means, okay, somebody's like they might be doing it every monthly or annual basis. Well, just because somebody is consistently coming back, say every 3 or 6 months, that's not really recurring revenue unless it's actually they're locked in at that. So as a rule, recurring revenue is something that is set to recur on a set date every year, or it could be every month or quarter, but it's a recurring something that recurs uh, over a set period of time. No, personal versus business expenses. This is again, a key area. Um, owner vehicles, personal travel, family cell phones. A buyer's going to look at it and go, okay, why in the world are these expenses being paid for by the business? Club memberships or season tickets. I mean, hey, if you're a huge Green Bay Packers or Chicago Bears fans, that's great. But writing that off as a business expense when it's really a personal expense, somebody's going to look and go, okay, yeah, I'm not sure that's legit. Family members without defined responsibilities. Sisters Susie, yeah, she might be showing up as having a paycheck of, say, $250,000, but okay, there's not only no job description, but it's clear, like, okay, what does she actually do? And, that's going to be a problem for a buyer. They're going to be like, okay, why is it that we have this going on? This doesn't make sense. It shouldn't be there. And then personal insurance through the business. Now, on a note, I'm not going to say necessarily that all of these are invalid. Like, for example, you could actually have vehicles that actually are company owned that you are using and you're using it legitimately for business. You could have, cell phones that you actually do really use for business. And just because of the fact that the way it is, it's structured. So I'm not saying that's a problem necessarily, but if you're getting ready to exit, it's the type of thing like, okay, well, let's get all of that off it, especially if you're not necessarily um, going to be, especially if you're planning on using it personally after the exit. So the act back reality here is it must appear on the tax return as an expense, and it requires supporting documentation, and you must justify why this expense will continue, and it needs to be subject to a reasonable test. Okay, so this isn't really a lot of rocket science. Basically, you just need to, what you could be thinking about is like, okay, just kind of like a research paper. You have, and your thesis is the statement about, like, okay, why something should be an add back. And if you have enough evidence to establish that, then okay, yeah, you're great. But you need to have the documentation and you need to justify it. And, it needs to be reasonable. It can't be something that somebody would look at and go, I'm not sure about that. I mean, I'd love to give you the benefit of the doubt, but I'm not sure. And if you're saying that, then yeah, it wouldn't work with a reasonableness test. Working capital components. Now, a lot of this, um, especially when it comes to aging, is like, for example, if you have um, basically aging on receivables, once you get to the 90 plus days, basically the value loss is about 40%. And then once you get to aging at 180 plus days, it's 10 to 20%. So that's another key thing. And that's why when it comes to business valuations, receivable and payable reports are taken into account. And if people are seeing numbers like this, that's really what they're going to be saying is you're going to have this percentage value at these points. And the reason why is because it's like, okay, well, it took 90 plus days and yeah, eventually you got it, but it took you 3 plus months to do it. And while you got the cash eventually, um, it, it really was not as valuable as it could have been, especially if you could have gotten it within 30 days. Now, here's the thing: 92% of the time, deals are going to include working capital adjustments, and 55% of the time, they're going to favor the buyer. So, this is why, when it comes to your working capital, the better you can position yourself, the better off you will be. Um, and it's the type of thing that you just gotta figure it out really quickly and just make sure that um, you just get everything positioned well, knowing that you're probably going to take some hits here. Inventory and fixed assets. This is another area. Inventory issues. Okay, you could have stuff that's now obsolete. Uh, Things are not consistently valued, and the physical count could be at variances. These are things that are going to drive down your inventory. And then with fixed assets, okay, a ghost asset. It's okay. It's written. It's appearing on the balance sheet, but okay. Well, actually, where is it? Does it still exist, or did you retire it? And it's the type of thing. It may actually be something that you did use it once, but you really should have depreciated until it was at zero. And then obviously missing depreciation schedules or unrecorded disposals, as I kind of alluded to. So, and here's an example: a manufacturing deal collapsed when $12 million worth of equipment is appraised at $3 million. That is a huge hit. So now that we've gotten to that, let's get into the tax liability, and this tends to be hidden. Now the economic nexus when it comes to post Wayfair reality is that it creates obligations in dozens of states. Um, Now, what's going to happen is the successor needs to know, are they inheriting any pre-transaction tax obligations, even in an asset deal? So, just making sure that, you are just completely compliant when it comes to taxes. That's why I work with a lot of tax professionals. And, this is why, we want to make sure everything that is owed is paid. But what is crucial and absolutely important is that we need to make sure that everything lines up. And I will speak to this. I am not a CPA. I don't work with taxes. This is not an area that I'm necessarily going to have all the answers on. But, I do have people I work with, and they would be able to help out here. Now, here, when it comes to GAAP compliance and financial statement quality, I'm not going to say that everyone absolutely has to go with GAAP accounting. I actually have an assessment form that I call GAAP compliance. Um, Really, what it comes down to is, we're just trying to make sure things are consistent. And, you could have something that it may be very close to GAAP. It may actually not be GAAP, but if you actually are consistent and everything makes sense and there's um, nothing that will make somebody go, then we're fine. But really, at the end of the day, the closer, if not completely compliant with GAAP, would be helpful just because of the fact that, okay, even though you're not going public, which would require you to be GAAP compliant, just moving in that direction, I would definitely recommend. And of course, obviously, the financial statement quality is we need to make sure they are absolutely accurate and have as much complete information as possible. And as you can see, okay, the audit, which is going to give you full assurance, you know, that might cost a good bit, but at the end of the day, let's be brutally honest. When it comes to the sale process, that is going to be something that's going to be required for due diligence. So, compilation and review are nice, but an audit, which is something that I'm going to say we need to do, is something that you should plan on doing. And the recommendation really here is that you review the statements at a 2 to 3 year minimum. I'd say at least three. Just so that way we're able to really just present transparency and clarity to the buyer. Now, related party transactions and debt. Required documentation, arm's length pricing, formal loan agreements, covenant compliance. In other words, we need to make sure that we have all of our ducks in a row. We have, when it comes to any related party transactions or debt, we need to make sure we shouldn't be lacking anything. And basically, I remember working in offense once and it was set to document everything. Well, that's the case here. And then change of control, most loans require lender consent and acceleration clauses can surprise sellers. So, if you have debt and, there's a new business owner that's wanting to buy, that could be a surprise. And, this is something that could cause the business owner that's buying the business to go, I don't really like this. I don't want to assume this since this is going to, change the metrics here. Now, here is your exit readiness scorecard. Um, Obviously, financial health is important. Under that, market position and operational efficiency, as well as management and governance, all come in at 15%. Now, I work with really all four of those areas. Um, and really, just, as you can see, if you can get those four areas in great shape, I mean, you're already 70% of the way there. Legal and regulatory, part of the reason why is just because of the fact that, depending on the industry, you may not necessarily have a lot of compliance issues. Obviously, like I know earlier this year with the One Big Beautiful Bill Act that went through, things were changed. So there's always going to be the type of thing like, okay, be aware of new legislation, both at the federal and the state level. But that's something that it might, but it's not going to be as big. Strategic vision, obviously where you're going is going to really help, but at the same time, the strategic vision, why it's really down here, not at the top, is if you have good strategic vision, those four at the top are going to fall into place really quickly because it's going to be very clear. Okay, if we want to get to where we're going, we need to have those four really humming. And then risk management, which again, it's interrelated with everything else. And so at the end of the day, what it should be clear is, well, there are certain ones here that are important and crucial. Really, the top four are absolutely pivotal. And after a while, everything really, it's kind of like the adage of a rising tide lifts all boats. Well, in this case, once we start getting into the lower ones, that's when, like, as everything is getting better, everything is going to have be helpful all around. Okay, so here's a financial health deep dive. Are your financial statements GAAP compliant? Again, they might not absolutely have to be, but again, the closer we can get, or even if we can say they're GAAP compliant, or at least they're consistent, that's important. Are your books closed within 20 days monthly? You know, if you're getting into basically the next month towards the end of the month and the books haven't been closed, that's a problem. Can all revenue be tied to to bank statements? Is there a 3 to 5 year history of accurate financials, and are profit margins consistent and sustainable? I mean, these are questions that it's not going to really take a lot of rocket science. Now, the gap compliant, you'll probably need to go a little deeper into detail. And again, that's where the assessment I have comes in. But the others, that can be answered really quickly. And at the end of the day, this is the type of stuff that if you're doing things right, it's actually rather easy fixes. Now, here's the green flag versus red flag checklists. Obviously, we want to have 3 to 5 years reviewed audited financials, monthly close ideally under 15 days, all accounts reconciled, clear add back documentation, and no material related party issues. That's a must. Red flags, obviously, if the financials don't reconcile, if we had customer concentration greater than 20%, we have a mix of personal expenses and unreported liabilities, as well as incomplete documentation. So basically, if you can make sure that you have those green flags and none of those red flags, you're in really good shape overall. So here is what I would recommend if you were watching this webinar, and it's really your 90-day assessment assignment. Complete the scorecard, a self-assessment, and start trying to identify your top 3 priority gaps. Now, ideally, they would probably be noticeable, but it's not like, okay, you have to do a lot. Now, if you're having to do a lot of the things here, then, there are other questions that might be in play. But the reality is, just really, and I'd recommend, going back to that list I had in the slide previously about those 7 areas, getting the top 3, maybe even adding in the 4th, because if you're doing all those, you're going to be in great shape and you'll actually start addressing indirectly the other areas. Now, then, try to develop a timeline. I mean, it may take a month, it may take 6 months, depending on the complexity. And then, here's what you can do is you can calculate the cost of inaction. Because again, if we're talking about say maybe 5 to 600,000 in EBITDA that is going to get written off just because of quality of earnings, we're looking at anywhere from 3.5 million to possibly as high as 6 million. So the cost of inaction, especially if we're getting ready to sell, could be massive. So here's the preparational timeline. 5 to 4 years out, that's where your foundational building, you're getting your accounting figured out, your systems. If you don't have a CFO, then you should consider getting one. Or, obviously, you could bring me on at that point as a fractional COO. I'd even say, if you don't, you might want to just start at the controller level, just because a lot of this work is going to be controller type of work. And then maybe what we would do is we would actually promote them up to CFO. I know that's what I would recommend if I were to come into a situation, is if we have somebody doing controller type of work, they got everything cleaned up, and it's like, okay, well, if it's clear they understand that and they have a sense of what it comes to strategic planning and budget development, okay, let's get that person promoted up to it. When you're 3 to 2 years out, that's when you should start optimizing things with reviewed statements, balance sheet cleanup, diversification. And then when you're 12 to 18 months out, that's when you need to start testing your transaction readiness, your sell side quality of earnings, as well as data room population. So, if you spread things out and you start early, essentially you're going to be in really good shape. Now, here's what cannot be fixed quickly, and this is why you need to start sooner than later. It could take you 2 to 3 years at least to get customer concentration diversification. If you have somebody taking up 30%, obviously I'm not going to encourage you to say, ask them to cut it in half. But what you need to do is you need to take the other 70% and grow it. So that way, that 30%, well, ideally it's at the same level, it starts to shrink closer to 10 to maybe 15%. Really, the lower that you can get it, the less concentrated you are with customers, the better. Now, one thing you really cannot fix is historical financial quality. It's not really retroactive. I mean, you could get things tightened up, but at the end of the day, that's really just something that what's done is done, and you can take steps toward improving it, but you really can't do much more. And then 5 years is the S Corp tax optimization waiting period. So, in other words, these are things that, if you're going to want to exit and you want to address these things, these are things you shouldn't be waiting until 12 months before the sale. These are things you should be doing, I'd recommend even a decade before. Start thinking about them way before the exit planning process is on the table. Now, the investment and return on investment. Preparation cost, depending on what the sale is, it could be anywhere from 35,000 to 150,000. You see the sell side, quality of earnings, financial statements, tax review. Now, with me as a fractional COO instead of a CFO, I'm 60,000 per year. So, obviously there'll be substantial savings there. Now, when it comes to hiring a CFO, which is what the eventual goal would be, obviously that would change. But, getting the preparation and things in order, you might think, okay, well, that looks like a lot. But here's the reality. The return on investment for the transaction, you could be looking at a $1 to $3 million discount. You'll be reducing your escrow and holdback and your favorable working capital. Now, obviously, these numbers will be subject to change. But what the point I'm showing here is this, is, with the reality here, these numbers should illustrate that, yeah, it's going to cost something, but you're going to be getting something substantial back in return. Now, here's the cost of inaction. Well, you could have up to 30% valuation discount for unreliable records. You could have a significant chunk of the purchase price held in escrow and holdbacks. 20 to 30% longer transaction timeline. Remember what I was saying earlier about those 3.2 LOIs? Well, you're going to be running into that as well as an increased failure risk. And, again, keep in mind 55% pro buyer working capital adjustments. I would even go so far as to say, let's just plan on the working capital adjustments going pro buyer. And if we just have that as kind of like the unwritten rule, that'll focus to be that much more efficient. And even though we might have some things go our way, we will still so much better position ourselves at the end of the day. So here is um, really the leadership evolution. Bookkeeper, is when you're at $1 to $3 million in revenue, transaction recording and basic reconciliation. The controller is when you're in the 3 to 10 million. Then that's when you have monthly close, budgeting, compliance annually. And then the CFO is when we're getting the 10 million plus or more or exit planning. And, that's, with strategy or forecasting. The fractional CFO, that's obviously an alternative. What I would do, obviously, is what my current setup as a fractional COO is. I have a monthly retainer of 5,000, and I dedicate 1 day per week. And the goal there is that really, well, I'm doing a lot of work that a COO would do. I'm also doing a lot of work that a CFO would do, and that's why. Even though I am showing this as an option, the reality is if I were to come on, it wouldn't be until we would be hiring a full-time CFO. And really my preference would be to hire from the controller position, someone internally, and then, maybe promote an accountant up to controller, just promote as much within as possible, but that might not be practical. So here is what your advisory team is going to look like. You're going to be needing to engage an M&A advisor, 12 to 18 months before the exit for formal process. The way I like to do it is I like to bring in the M&A advisor about 3 years in. Um, and, even though the fractional COO/CFO is not mentioned here, I'm focusing specifically on the financial side. And what is going to be happening here is I will actually be working with you and basically with all of these others. The transaction CPA is going to be different from the day-to-day accountant, and they're going to have quality of earnings expertise. The transaction attorney who is probably going to be engaged by the M&A advisor. They're obviously going to have specific experience. And then your wealth advisor, who ideally is somebody that you've worked with for a long time professionally, they're going to be really starting the tax planning anywhere from 2 to 5 years before exit. I know in other presentations I've put down 2 to 4, but really, once we start getting things coming clearly into focus, the sooner the better is my mantra. Okay, so when to engage each advisor with a fractional CFO or with me as a fractional COO, and strategic planning with an M&A advisor, as I said earlier, it's about 3 to 5 years out. 2 years out is when we bring in a transaction CPA for compliance review. 18 months out is when likely we're going to start developing a formal M&A advisor engagement. 12 months out is when the transaction attorney and wealth advisor are going to be active. And again, that's going to be probably the transaction attorney is going to be more on the M&A side, working with the advisor. Wealth advisor is going to be working with you. And then, 6 to 9 months out, which is when due diligence is really kicking up. That's when we have the sell side quality of earnings as well as data room preparation. So here is your 12-month action plan. And, is you need to assess your complete scorecard in the first quarter, identify gaps, engage a CFO, or if you don't have a controller, get a controller first, and then begin your monthly close, just consistently doing that. Second quarter, implement accounting software. This might sound odd, but I'm going to give you a good example. QuickBooks Desktop, it just went, it's no longer in use as of September of 2024. So you're going to need to migrate to something else. So make sure that, you have the right accounting software for your business. this might seem odd, but the reality is there are a lot of businesses out there that have been going with something that works. But the reality is, while it does work, the problem is, it's not ready for this next step. Start establishing policies. I mean, make sure that you're gap compliant. Again, while I don't say you absolutely have to be, the reality is if you work towards that goal, you'll be in great shape. Segregate expenses. Well, make sure that you keep the personal and the business separated. And then any add backs that you're having, make sure that they're documented. Now, with remediation in the third quarter, you want to address any compliance gaps. In other words, you want to be going through everything with a fine tooth comb and making sure that if there are any compliance gaps that they're addressed. The tax nexus study, clean up related parties and improve working capital. In other words, what you need to be doing during this time is you need to make sure everything is not only tax compliant, but your working capital is as efficient as possible. Consider tweaking your receivables policy just to make sure that, you're not necessarily having to wait an extended period of time for somebody to pay. And then for preparation, obviously, you know, it says here engage transaction CPA. Probably the better thing is, start talking around as well as begin, your data room where you're storing stuff. And, it doesn't have to be just financial. It could be all of your policies, processes, and procedures for your business. And then you should consider your review statements and really start working toward developing projections. Now, with those projections, you don't necessarily feel like you absolutely have to get them right initially. I mean, as time goes on, you'll realize, okay, you'll tweak it. You may even discover you need to bring on an analyst or have somebody works there, who's good with numbers, maybe as a data scientist. Start doing some analytics work as well to help with developing your projections. In short, this 12-month action plan, it's not going to get your business ready, but it's going to start the ball rolling in the right direction to make sure that a lot of the issues that you might have with the books get corrected as quickly as possible. So here are 5 non-negotiables. Start at least 3 to 5 years before you exit, because exit prep is a marathon. Um, you know, I I tell people if you're 3 to 5 years out from exiting, uh, I want to be talking with you just because I feel like I can help you out. You need to invest in financial leadership. While obviously that says a fractional CFO, again, I'd recommend getting a controller first, just because they're going to be looking backwards. And then obviously, once I'm contracted as a fractional COO, what's going to happen is I'm going to come in and, we're going to hire the CFO and likely hire a new controller. Obtain GAAP compliant financials and minimum reviewed statements. Again, not an absolute imperative to be GAAP compliant, but if you just make sure that you are consistent and you're essentially following GAAP guidelines, you'll be in great shape. Which is why I'm not saying, well, I've not come across. I mean, obviously, some M&A advisors may require GAAP compliance, some might not. The reality is, if we can just make it a habit of doing it, that's like maybe extra icing on the cake. And then get the sell side quality of earnings, which is now really a standard practice for transactions above 3 million. And then, start building out the data room continuously. I mean, you have a lot of institutional memory that you should have documented. So, with that having been said, you may have questions. I would love to answer them. And what I would encourage you to do is just shoot me a message on LinkedIn or in the description of the YouTube video description. There's a link to my website. Just go there and maybe set up a 30-minute exit readiness consultation, and I can sit down and walk you through it. And again, a lot of the stuff I'm discussing here, this is not completely my realm of expertise just because I deal with operations. There's a very good chance, depending on the nature of what needs to be done, I would bring in somebody to assist specifically. But, obviously, if it's not too big of a job, we might actually be able to get away with, just me doing it. But, really at the end of the day, if you have any questions, just feel free to reach out. And I'd love to talk with you. And thank you all again for your time, and hope you all have a great rest of the day, as well as an even better conclusion of the year. And hopefully next year is an even better year than this year was.